Rich, today we're sitting down with Ryan Urban with Alpha 4 Management. He's also the author of the book, The Business Owner's Guide to Money. And if there's one thing that business owners like is money.
And he breaks down the difference between a sole proprietorship, an LLC, an S Corp, a C Corp in very simple language I think anybody can understand and identify where they're at and which one may be good for them.
Yeah, and I think the golden nugget of today's conversation is when we start talking about how business owners look at their financials on a monthly basis and what do they actually do with them? How do they actually look to optimize their numbers to try and earn that more money and that wealth they seek in their business? So can't wait to jump into this with Ryan Urban. This episode is being brought to you by IOI Ventures. We all know that digital marketing is vital to our company's growth. Unfortunately, many of us entrepreneurs don't know where to start. We simply feel overwhelmed by acronyms like CTA, CRM, and GA. It's time for all of us to stop feeling stuck because our partners at IOI Ventures have the experience and track record to get us moving in the right direction. Want to learn more? Go to ioiventures.com/EU and sign up for your free 30-minute consultation. Ryan, welcome to the Entrepreneurs United podcast.
Thank you. Good to be here.
Absolutely. We had a chance to talk with each other on your podcast, and now we have you on the Entrepreneurs United podcast. And I enjoyed our conversation. You and I connect in a certain way, which is finance. We love the idea of problem solving through finance, and would love to really share some of your wisdom with our entrepreneurs today in terms of how you've been helping people and entrepreneurs through your career. Can you tell us a little bit, Ryan, about what you do today? And we may dive a little bit deeper into how that came to be, but what do you do today in your profession?
Today, after selling my practice last year, I just work with individuals and business owners on a few things, and I do it on an hourly fee basis only. So I'm not doing the percentage of your assets or anything like that. And a lot of people just need some basic guidance rather than something very intensive. So I just do that, and I'm enjoying that and learning how to be really bad at golf. Aside from that, that
Well,
pretty much covers it.
with a little more practice, you never know where you know what you can achieve. But okay, so when you work with people in the world of finance, how did that come to be for you? Talk to us maybe a little bit about your journey through your career and how that led you to I'm going to help people with finance.
I've had two careers. The first one, my degree is in broadcasting from San Jose State University, and I was in broadcasting for about 20 years. And it was weird, John, because the whole time I just had this feeling that I was just doing that until I figured out what I wanted to do when I grew up.
Hmm.
And one day I was doing an appearance where they pay you to show up and say hello to people. And I was sitting in my car at a 7-Eleven in Santa Cruz, California. And I said to myself, I don't want to do this anymore. What am I going to do? And I've always been fascinated by finance. I'd done some investing. And for whatever reason, it was just the obvious answer. And I said, man, now I got to go through years of, you got to do training and education and pass tests and all this kind of thing. And it hit me, the years are going to go by anyway. So I may as well not look back and regret and wish I had. So I became an advisor, independent right away, which I don't really recommend. I didn't have a hand helping me all the time. But
Mhm.
20 years later, I was enjoying it very much. And I love this stuff. And it's just, you said something so important at the very beginning. You talked about problem solving, and that's what this is. It's providing a roadmap and helping people out. And last July, I got a call from a group in town who heard about me and wanted to merge with me. And I said, I'm not going to retire anytime soon, but I'm probably closer to retirement than doing all that stuff. And they go, oh, well, that could work too. And on October 31st of last year, in fact, just a year ago, we signed the documents, and that was it.
Wow. Okay.
Yeah.
And to be more specific for our listeners and for us, when you work with individuals and or businesses, are you helping them on finance from the perspective of wealth management, investing assets, that side of things, or on their finance department and cost controls and balance sheet fitness and all those kinds of things?
A little bit of both, but most of what I do is on the financial planning and asset protection side and investing side.
Okay.
And however, when I work with business owners, and in fact, my book goes into things like mitigating taxes and the various types of business reports that are so important. And that's one thing I talk quite a bit about are things like making sure that you're all of your statements are up to speed. So it's a mission creep kind of thing. I start with one thing, and because I have experience in the other things, I help them out as well. And my tagline is at the intersection of your business finances and your personal finances. And
Mm.
because the two go together. And so there will be oftentimes that they'll ask questions outside of the regular sphere. And but if I don't have the answer, I know what questions to ask to get it. And I can help them in that way as well. But for a business owner, it's so complicated because you have your business finances and your personal finances. But the thing is, they're linked so often that you have to be able to talk about both.
Mm. Yeah. And I'd love to dive deeper into that. What is the name of your book?
The Business Owner's Guide to Money.
Perfect. So, The Business Owner's Guide to Money. When did that come out?
First edition was about 6 years ago, but I update it because numbers change every year. Things like maximums for IRAs or things like that. So I'll go back in and redo it because you want to stay on top of it. But most of the things do not change. One thing I've had to change and I've been adding to every year is the tax planning. Because when you're doing your taxes, whether you're an individual or your business, you're looking in the rearview mirror. You're looking at the previous year. And what I try to tell people is you got to look through the windshield too. And so you can plan ahead for mitigating taxes as well.
Book something that you sell, or is that something that you give away to customers, clients, or how do you manage your book and its distribution?
Don't tell anybody, but if someone just asks, I'll email them a PDF version.
Should we cut
Uh,
that out of the recording?
no, it's on Amazon. But no, if your listeners want to get a hold of you and you can just send them the email, or actually I'll email it to you and you can send it out if you want to.
Oh, that'd
I
be great.
Yeah.
And what do you often get complimented on the Business Owner's Guide to Money? What are two or three things that you often hear? Wow, that was really insightful.
There are two things, and it's funny because you don't expect stuff like that. The one thing that really surprised me, and I've heard quite a bit, was how complete it is, but it's not long. And the reason for that is the other thing I hear, and that is that there's no fluff. It's just all, and that's how I do my show. That's how I do everything. I don't do a lot of fluff, and I want to get to the point, and I want to solve the problem and get her done and move on. And so those are the two things I hear most about it. I was a little surprised because you never know when you're writing a book, is it complete enough? But you go back in and you go, I could probably add this. When I talk to people about this a lot, I'm going to throw that in there. And suddenly it's a little bigger than it was before.
And along the lines of no fluff, when you're talking about mitigating taxes, give me the no fluff answer. What are two things that every business owner should be doing? Just cut to it. What can they do this year or tomorrow to mitigate taxes? It's a big
This,
thing.
there's a lot of things you can do, but yeah, there are two things that I preach all the time. Number one is organization. And if you're a business owner and you're giving your tax preparer a box of receipts, you're doing it wrong because they are not a mind reader. And if they can't go in after the fact, remember I said they're looking through the rear view mirror and they're only operating on what you're giving them. And virtually every CPA now will provide you with a questionnaire that asks a lot of questions. Please go in there and slowly just bite the bullet. I know I don't like it either. I don't like doing it either, but bite the bullet, go in there and fill that sucker out. Make sure it's completely filled out and give them as much information as you can because they're they're not mind readers. They can only do so much. And the second thing is to communicate with your tax preparer. Again, you're not just handing this off to them. This is both a process and a team effort. So please ask questions. Start off with things like, is my business form correct? Should I be an S corp? Should I be a C corp? Should I be an LLC? That's the big first one, by the way, that we have to ask. So be organized. And by the way, when you organize yourself really well, you become more knowledgeable on your numbers anyway. All right. So be organized and communicate well with your tax advisor and force the issue. You probably won't have to. If you're proactive, they'll most of the CPAs will say, "Okay, yeah, let's do this. Let's do it."
And what would your cliff notes be on the S corp, C corp, and the LLC? What would be the one or two sentences that you go, you should look into this if you're looking to, or if your
Yeah,
business is set up? What's the cliff note version of that?
great question. So really, there are 4 levels here. The first is a sole proprietor, and that's where it's much easier, but you're totally exposed legally. The sole proprietor is you only want to be a sole proprietor while you're getting this thing up and running to make sure it actually works. After that, you have to move on to an LLC of one kind or another. The first basic kind of LLC is provides opportunities for tax savings and write-offs and everything else, and you are protecting yourself also legally. The second kind of LLC is moving up to the S corp, and that is where if your taxes are a little more complicated, it's going to behoove you to go ahead and do the S corp. It'll cost you X hundreds of dollars to move from the regular LLC up to an S corp, but that is going to help you more on your taxes, and that really as your income grows. Don't worry about being a C corp. More than likely, and remember, there's squish here at all times. But a C corp is only going to be for someone, in my personal opinion, who's either going to sell stock in the company or is looking at merging with another company. Most small to mid-sized business owners don't need to be a C corp. So it's sole proprietor, LLC, S corp, C corp.
So get your business started. Don't wait for your LLC. Get things moving. Be a sole proprietor at that time. Know that you have no protections legally or taxation wise as you're getting that LLC. When you get the LLC, hey, you're going to be able to write a few more things off. There are going to be tax savings. You have some insulation for you in terms of personal liability legally.
Mhm.
And then as that business grows and things get more complicated, there's more revenue, there are more profits, or more people involved, more projects involved. Consider an S Corp for even a little bit more taxation and protection. And then lastly, if you're looking to sell stock or you're looking to have a merger of some sort, a C Corp would be a way to look at it. Would that be the Cliff Note version of what I heard?
Absolutely perfect. And all along, stay in contact with your CPA.
Okay.
Okay.
What is a piece of advice that you often reserve for your clients who pay you?
Oh, okay. When we're doing investing planning and when money is actually being invested and put at risk, I make them one promise. And you're not supposed to make promises in my business, but I make them one promise. And I say, this is gonna go down. It's gonna happen. And let's get that out of the way. So we back up from there, and then we have to have a good talk about risk management. And I learned something interesting along the way, and that is there's a big difference. If I tell somebody, and I learned this over and over again, if I tell somebody they can lose 20%, okay, they'll say, okay, I know I got to lose. But if I say you're going to lose $100,000, that's different. It's so strange. And even if it's the same number, but if 20% is $100,000, it sounds bigger. And so please have a good grip on how much risk you can take because when you dive into an investing program, it's a plan. And if you're jumping in and out of plans, you're asking for trouble.
Changing subjects here for a minute. I have a belief that every household is really its own business. It's really its own balance sheet
Yep.
and probably should be its own LLC. What do you think about that?
So you're talking about just a regular family without a business?
I think that every household is like a business
Hmm.
and that they should consider having an LLC, a limited liability company, as a part of their business operation, meaning find a business that you and your family could participate in,
Gotcha.
consult in, invest in. It could be investments in real estate, it could be investments in side projects, it could be consulting, it could be whatever. That I believe that's a really good vehicle for individuals to also have asset protection, movement of wealth from one balance sheet of a company to another balance sheet of the company, tax mitigation, and so forth. Have you ever seen that, or do you agree with that?
Is it okay with you if I steal that idea?
Yeah,
I like that very much because, yeah, what you're doing there, not only are you building wealth and not only are you protecting yourself and saving on taxes, but you're involving the family
yes,
in the process. And that's a gift that most people aren't able to give. But that kind of a business can be something as simple as an individual rental property
correct,
because you want to put an individual rental property in an LLC anyway.
correct.
I think, yeah, it's a, if nothing else, it's a good goal to have. But if you can find something that the family can do, and not all businesses require everyone working 80 hours a week. It could be something you buy into. It can be a real estate investment trust, for example.
Yeah,
But that way, yeah, I think that's a great idea. And anytime you can get the kids to get on top of numbers and get on top of finance, the earlier the better. And
correct.
it's funny because in my years doing this, when I was doing regular financial advising, I had many families where the child got their first job and right away they came in to see me, and it was $50 a month for an IRA. That's all they could afford.
Yeah,
But they were 18.
yeah,
And I said, you don't know this yet, but you're really going to appreciate, you're going to be proud that you did this.
yeah. And
And
part
we
of my
would go over
logic,
how it works.
yeah, part of my logic there, Ryan, is not everybody has a side gig or a business or real estate to invest in or whatever. But I'm a big pusher and believer in being entrepreneurial and
Yeah.
controlling your own destiny and doing things of that nature. But you're right. By having a limited liability company, my two sons work for our family business. They have job descriptions. They get paid on payroll. They get payroll taxes out. A certain percentage of their money goes to their spending allowance every month. Certain percentage goes to savings and investments, and then we invest it. But there's real work to be done, and there's habits to be done. But that business in and of itself that generates income also has expenses.
Yep.
And when you have multiple entities, I'll give you a really good example, right? In if you're a business owner making really good income in business A,
Hmm.
one way to mitigate tax, as an example, is go buy a car wash with accelerated depreciation, and it'll eat up all your taxable income over here. And now you have a new business. So instead of sending 45% to Uncle Sam, you basically have reduced your taxable income potentially to zero,
Hmm.
hypothetically, based on the business you just bought. And that 45% you would have sent to Uncle Sam helped you buy another business.
Yep.
And so there's ways by developing these new LLCs and reinvesting into hiring more people, investing into the economy. Ultimately, that's what the IRS wants you to do
Yeah.
is they want business owners to reinvest, to hire more people and grow. And that's why you get that benefit. But that one of those could be your own personal LLC. And yeah, please grab it. I was curious if you had ever heard of that or would subscribe it because I've subscribed it a few times and it seems like it works for some people that do have auxiliary income.
Funny thing is that's one of those things that the kids, once they see how it works, it's like investing too. Once they see how it works, many of them catch the bug
Hmm.
in a good way. And yeah, I love it. It's a
Yeah.
great idea.
So I'm curious on along the same vein, if balance sheet A is your company's balance sheet and balance sheet B is your personal balance sheet, what are some of the effective ways you've seen entrepreneurs move wealth from one balance sheet to the other than just plain distributions, which are taxed and at that point?
It's not easy. There are a few little tricks, and while I'm on that, one mistake that people make is they, especially on taxes of any kind, whether it's business or individual, and they tend to think that there is this secret pot of tax write-offs somewhere, and all they got to do is tap into it. There's a finite number of tax write-offs. There are only so many. So you did one of the first things, and that is you employed your kids because right away that circulated money within your family, but also it became a tax write-off, and that's one of the first things that we show people, and I've done it myself. I've hired my kids back when they were younger. So that's an example, but there aren't too many. So all you can do then is you can balance, because remember, and I'm sure as you folks know, when you're a business owner, you're trying to make your personal income as low as possible. And there are some ways to do that. Now, one way to do that out of the business with tax advantages is going to be something like an SEP, which is what I had, which is like it's a retirement plan that has a very high maximum,
Yes.
and they're wonderful, and it gives you tax advantages there. but also it gives the individual tax advantages and it gives the company tax advantages as well too. So there you go. There are only a few, but they're going to be oriented in that direction.
Yeah, I don't know if SEP is the same. What does SEP stand for?
Special special plan, special E
Okay.
plan. Ah, drew a blank.
Employee benefit plan, maybe, or something.
Something.
Yeah, in our business practice, we have a 401k profit sharing safe harbor cash balance program. And to your
Yeah.
point, the maximum allowance that anybody in the according to IRS can put into their 401k, I think this year is around 23,000 or something like
Mhm.
that. But because you're an owner providing a profit sharing cash balance program to all of your employees, they benefit from that.
Mm.
But you get to put in up to 10 times the maximum allowance of the IRS into your plan, which is all tax deductible. And it's a transfer from balance sheet A to balance sheet
Yeah.
B. And they want you to do that because everybody wins. The employees are winning, the company's winning, the owners are winning. But that's a commitment to really, be willing to share profitability and whatnot with your team.
A
Uh,
cash balance plan. I don't know how that even exists. It's if a company is doing really well
yep.
and they're liquid for at least a few years, a cash balance plan is unbelievable. The other thing that you're doing, and again, I'm sure you know this, is when you have a profit sharing plan, you're involving the employees in a way that they can't be involved otherwise.
Yep.
And that's something that they do remember. And knowing you, you and I have spoken before, and I suspect that how to leverage that to remind your employees, look, we're in this together. Yeah, what you're doing, if you have a strong ongoing concern here, what you're doing is perfect.
Yeah, no, I appreciate that, and it's something that I keep trying to. To your point, there's not a ton of methodologies, but always want to try and see if there's anything they could do to benefit everybody and create the win-win situation.
Absolutely. And you motivate them to stay. It's hard to find good people, and you motivate them to perform better. Yep.
Ryan, things are constantly changing in terms of the investing climate. And is it a good time to get in? Is it a good time to get out? What about this world event? What about this going on politically? Can you speak to us about what the current investing climate is?
Hmm. First of all, you hit it, and that is it is impossible to time anything. And I know that it sounds like a cop out to say that, but it really is true. There's just no way to know because you could stay out of it like right now, and I'll get into it. But right now, boy, it's definitely choppy. And you could say, okay, I'm going to wait till it's no longer choppy. How do you know that? And it could go up 25% before it chops back down. And so your opportunity cost there is ridiculous. That's really important. So when you're ready to do something, you need to go ahead and do it. Now you can do it smart. And one example is like right now, there's a decent, I would say, and for me, this is a high number. I would say there's a 40 to 50% chance that we are going to see a slowdown here. And the good news there's always a silver lining. The good news there is that is going to help interest rates and all that to come down somewhat. And also, if corporate earnings stay the way they are, the two are not necessarily connected. We could have a slowdown, but corporate earnings could remain the same. So what would happen then is, oh no, we have a slowdown. I'm getting out of the market, and then corporate earnings stay the same, and the market doesn't tank. So you just don't know. So one smart way to do it, if you're not sure, is to do what's called dollar cost averaging. And that means that, for example, if you're buying into a mutual fund, when you're buying into a mutual fund, you're not buying stocks. You're buying shares of the mutual fund, which is then investing in stocks. So when the market goes down, let's say you're putting in $200 a month, and right now the mutual fund is selling for $20 a share. All right. So this month, I'm getting 10 shares. If it crashes down to 100, next month, I'm going to get twice as many shares. And when it comes back up, you're going to have that much more in terms of shares. So that's a way to do your best to deal with a market that's going down. Don't try to time it. It ain't going to work. And just make sure, again, and we go back to this risk tolerance thing, don't take risks that you're not smarter than the market. I've
Are
learned
you
that.
also a believer in static rebalancing?
Generally, yes. Now, the reason I hesitate is because it depends on the nature of the account. If you have a very active account, like what I'm doing for myself is stuff involving options and things like that that I couldn't do for clients the way I'm doing it for myself. And so I'm doing a lot of rebalancing as I go. Whereas doing a rebalancing once a year is always a good idea. And also it again, it reconnects you with your account and makes you see it, makes you look at it. Because this is so psychological that anytime you can touch your account, it ain't a bad idea. Now you don't want to overdo it either. And what a person will do is they'll go, "This fund did so well, I don't want to cut anything out of it." Yeah, that's maybe a good time to cut something out of it after it's gone up like that. Don't worry. Do what you're supposed to do. And timing or thinking that this number is going to do that, forget it. It ain't going to work.
If you're not all that active in your portfolio, which
Mhm,
you are active, if you're
mhm,
not,
mhm.
it sounds like you would recommend then static rebalancing at least on an annual basis, where you're
Yeah.
essentially selling what has risen and buying what has dropped
Mhm.
and doing that annually at a minimum.
Yeah. So what for example, then if you have four different mutual funds, they're all going to grow at different numbers. So one's going to be 28, one's going to be 21%. You started off at 25% of each of four. They grew differently. Then at the end of the year, and typically that's when it's done, it doesn't really matter when, you're going to go back to you're going to buy and sell so that it goes back to 25% each one. So that's what rebalancing means. And I do know people who do it semi-annually every 6 months. Seems I don't really know what the advantage is there, but I have run the numbers on rebalancing, and it pays. It's worth it to rebalance. And you always also that also gives you a chance to review: Are these the funds I want to be in? Do I like what I'm doing here? Because that might also be a good time to try something, a different fund, for example, or a different allocation.
QuickBooks Online, what's your opinion?
I'll tell you, I haven't had much in the way. I haven't had much in the way of complaints from clients, and that's how I judge things. There's so much training available on QuickBooks Online that I know that there are a couple of options. But another thing to consider about QuickBooks, and I'm not being paid to say this, is that when you hire somebody, it's fairly likely they're going to know QuickBooks more than they're going to know something else. It's a translatable skill. I have to tell you, I don't know enough to know it, say it inside and out, but I go by what I've heard.
What are the top reports on QuickBooks Online that you feel like every business owner should be getting into?
Okay, there are your income statement and your balance sheet. Those are the main two, and I'm glad you asked that question because this is another hot button for me, and it really doesn't sound like one. What generally people do with their income statement and their balance sheet is they run it because they're supposed to, right? I'm supposed to run this, and then they put it in the drawer or they just save the file. What I look at these two documents, and I really try to get my business owners, friends, and clients to do this, is these are a bunch of questions. You want to look at these two documents, and these are not big documents. They're not long documents. They can be done on one sheet if you're a mid-sized business owner or less. Go in there and ask questions on every line item. Am I optimizing this line item or am I not? And it could be something as simple as insurance. Am I optimizing my insurance? Am I underinsured? Am I overinsured? Have I gotten a quote on this recently? And then you just go down the line. Cost of goods sold. There's a lot of things that can be done there, especially if you're doing something retail or something that has an inventory. But on and on, every line item should be a question. And if you have a key person with whom you go over these documents every month or quarter or whatever it is, involve them. Try to get some other voices in there so that they can say, by the way, I think we can do better here. Great, thank you. Okay, because there's only in, go, and out, go. And the balance sheet and the income statement are where you're going to see it.
You know, that's the golden nugget of this conversation. Way too often, we pull these reports. To your point, we send them out. We send them to the bank. We send them to our investors. Put them in the drawer or in the digital drawer.
Yeah.
But not too often. Maybe annually, do we look at them and go, is there anything we could cut out here? Is there anything we could do here? But we don't ask, how am I optimizing this line? And answer the question. Like literally
Right.
put it in a spreadsheet and answer every single question and assign things out to it. And as your business grows, one of the things I found, Ryan, was you'd be like, "Well, this looks a little high. Let's look into this line. Like, why is our telephone bills expenses so high?"
Right.
And we look into it, and this is no joke. This is going to date me a little bit, but we look into it. We were paying a service called eFax for 5 years and not even using it.
There you go.
Now, it wasn't
Yeah.
a big expense,
Yeah.
right? It wasn't a big expense, but the reality is we just weren't digging deep into it, right? We signed up the subscription. It was hitting our credit card every month. It was then getting coded to the right thing in QuickBooks. And next thing you're like, well, what's this line again? Or
That's right.
What's within this line? But if you do it every single month and you look to optimize it, and you can't optimize everything all at once, but it can really
Right.
direct it. This quarter, we're going to work on these 5 things. And this quarter, we're going to work on those 5 things.
You got it.
Talk to me about a success story from the perspective of a client you've worked with. You don't have to give
Mhm.
us the name, obviously, but that may be a typical entrepreneur you see out there that was in position A. They were trying to do something. They work with you to advise them, and you help them accomplish the goal. What does that typical success story look like in terms of how you can really help entrepreneurs and create wealth for themselves and their families?
I'll tell you, the one that really pops to mind was a company. When I sold my practice, I lived in Colorado Springs, and now we moved out to the Carolina Shores here. And I had a client in Denver, which was, what would you say, business services. And it was just simply one of those situations where they couldn't see the forest for the trees. And that's so easy. I shouldn't say it's easy, it's so typical. We all have that. We all have that problem where we're just trying to run this thing and a lot gets by us. And the old saying, work on your business instead of working in your business.
Hmm.
They were looking at doing a little expansion. And so what I always do, I'm naturally curious. And I think this goes back to my years in broadcasting because I interviewed 2,000 people probably. Anyway, so I started asking questions. And there was a guy there who is a kid. And I'll never forget this. He just had an answer and he just heard me. It was just the communication was amazing. And communication to me is really key. To make a long story short, we asked a lot of questions. I kept bringing this kid in to our conversations. Do you mind if we bring him in? Yeah, yeah, bring him in. What I saw was that his temperament and his curiosity was absolutely perfect for this new thing they wanted to add.
Mm.
I played matchmaker. It was a weird deal. Maybe this isn't the best example of what you're talking about, but I was listening and I was seeing the big picture from the outside. And so what they did was they changed and then I helped them put together a plan to incentivize him financially so that later he's going to be able to buy into the company with some tax advantages.
Mm.
And boy, they love that because when I said I think that was what actually sunk the whole thing, is got this whole thing going. So they added this new. It was a complementary business. They put him in charge. I helped them put together this financial package for him, and then suddenly I made an extra client because I had
Yeah.
the two of them. But it's thriving today, and I'll tell you that the punchline of all this is this kid had no business education, none. He just was a natural. And that's where you want another nugget. I'll tell you
Yeah.
this. I've heard this saying, and this is where I really learned it. If you're having a hard time hiring somebody, finding somebody, because you're trying to match their skill or their training and their experience with something that you want to have done, a great line that I've heard, and that's what we did with this kid: hire the athlete, teach them the game.
Mm.
And what that means is, do they have the requisite temperament, intelligence, curiosity, and fundamental skill set to do this job? And can I coach them up rather than bringing someone in who may have bad habits, who may, you list them
Yeah.
off. There
Yeah.
could be all kinds of potential problems.
Exactly.
But if you get somebody like that, don't lose them. And so that requires the business owner to really be plugged into what this person is doing, all their people. But if you find somebody like that, find a way to manage them up.
Yeah. And you started off, or we started off this conversation with one of the things that, brought a twinkle in your eye too, is I love solving problems. You just gave us a fantastic example of that. How do people find out more, learn more, get in touch with you?
Our website is Alpha for Business, alpha, the number 4business.com. All my information is there. The email is Ryan, Ryan, at alpha4business.com.
Awesome. And the Business Owner's Guide to Money can be found on Amazon, and or if you reach out to us, especially said you saw this podcast, we'll send you the ebook right here. Brian, thanks for the conversation. Really appreciate it.
Great
Thanks,
fun.
Brian.
Thanks, guys.
Please stick around for a few more minutes while Rich and I break down this episode.
John, you know I love the last nugget that he called the nugget, which is hire the athlete, teach them the game.
Yeah.
Oh my, I've never heard of that before. We've heard hire for will, train the skill. There are a whole bunch of different ways to say it, but that's a different way to say it that connects a little differently. Hire the athlete, someone who is athletic, and then teach them the game. And to convert that into business, hire somebody with business acumen, and then you could teach them your business.
Yeah, no doubt. I think way too often we try and find the square peg for the square hole. And at the end of the day, a lot of the top performers I've had in companies, and maybe you've even seen in companies, didn't necessarily come into that company with they're best suited for this particular role for the rest of their lives. They flourished through the organization. They learned another role. They learned another role. They got better at this. They got better at that. And whether it be the will, whether it be just that internal drive they have to be a sponge to learn, their fundamental skills and abilities to be able to communicate with people, be able to hold a conversation. When they get into something, they do it first class. They deliver what they promise. Some of these core values too really can deliver what you need. Now, there's certainly some roles where you need specific training and skills as a prerequisite. But I think sometimes we got to look a little more broad to finding that athlete and teaching them the game. I love it as well.
Another one I have highlighted here is, am I optimizing this line item? And really going through and scrutinizing everything that we see on a balance sheet, everything we see on an income statement, and asking ourselves that question. It is so easy just to print those things off, not look at them, sometimes not even send them to anybody, just have them. It's a staple in time, as though you're actually going to go back to them later. To actually take the time and look at every line item on that. This is, it must be the third or fourth time that I've heard that over the course of the last several months from someone in the financial area. It is so important. It just keeps showing up.
Yeah, but there's a reason why entrepreneurs don't take the time to do deep dives in their financials every month. It's sad, but it's true, because they're working so hard in their business. They're down there chopping the trees. They get the financial statement. They look at the revenue. They look at the bottom line. They go, okay, good. I got to do better next month. And they go back at it again because they don't have that ability to slow themselves down to be able to do better. I can't remember who talked about this on our podcast. It was exactly that. They said, sometimes you just got to slow yourself down to be able to see what's going on so you can be more efficient as opposed to just running hard. But the reality is being an entrepreneur is tough, and you got problems every day, and you're working through the business. You're trying to solve this problem, that leaky bucket and that leaky bucket. So creating that discipline is really what I would challenge, Rich. Like, how can an entrepreneur do that? And I think one of the ways to do that is have that accountability coach or accountability peer. And what I mean by that is a sole entrepreneur, maybe, yeah, I'm not accountable to anybody. Just put that over here. I'm going to move on. But if you have a CFO in your business, a bookkeeper in your business, if you have a partner in your business, requiring you guys to sit down every month when the financials come out and look at them together and ask yourself that question: am I optimizing this line? Am I optimizing that line? What action plans can we put in? And you can't do everything all the time, but you could probably pick the 3 or 4 top buckets where you can really move the needle if you had that conversation every single month. So if you don't have anybody to have that conversation with, find somebody. It could be a coach, could be somebody, but have that accountability to do it.
I was just going to double down on where you ended. You first named a number of people who could be in the business: CFO, a bookkeeper, a partner. It could be somebody who you met at BNI. It could be somebody who you met at a chamber of commerce. It can be just a friend of yours who happens to run a business. Find someone who's trusted, who you can be accountable to, who you can do that every single month with, where if you don't show up, somebody's going to know it. That little touch of accountability is going to get you over the hump to actually do it.
Yeah. And that's why sometimes, Rich, to that point, I just want to challenge your comment there for a second, but not in a challenging way, just more in a conversational way. If you say, hey,
you can be challenging too, by the way. I don't
Yeah.
mind you being just challenging for obstinate's sake.
Yeah, no, I love it. But the reality is, if I call somebody I met at the Chamber of Commerce meeting and said, hey, can you be my accountability partner? I want to get on with you every
Yeah.
Monday and show you my financials. The reality is they may love you. They may trust you. They may show up for the first week or two, but they also got their stuff going on. And sometimes we're penny wise, dollar foolish. As opposed to hiring a coach like Ryan or like anybody else who's in this industry who can look at your financials with you and go, I've seen this 100 times with businesses. You got a problem over here. So really, I think there's a certain degree of hiring an expert, right? We use the Tom Brady name way too often in this episode about needing coaches, but if Tom Brady just said, I need an accountability partner or somebody come work out in the gym with me to make sure I show up, then yeah, maybe there'd be somebody there showing up to work out with him, but he's not going to learn how to make his body a better machine as opposed to hiring a high level skilled professional. So sometimes I think we chimp out on that. By the way, I've done that. Oh, I don't need to spend money on that. I can review my own P&L myself, but there's a lot of value in that. And you could probably get a really good return on investment there as well.
I agree. There's no challenge in that. I think that is what's optimal.
Yeah.
But if the choice is hire a professional and put money in that,
Yeah.
or don't look at it versus just find a peer who's going to force you to look in it, just get your nose in it.
Yeah.
I'd say get your nose in it. If that's where you are and you're just not even looking at it, get your nose in it and figure out a way to be held accountable to do that. I agree with you. The ultimate would be have somebody who has some level of expertise to help read the numbers, look at the ratios, make suggestions based on like businesses or unlike businesses sometimes.
Yeah, yeah, and what I liked about Ryan too, Rich, that we didn't really talk too much about with him, but I want to bring it back is a lot of financial advisors get paid a certain percentage of your assets, right? So 0.5%, 1%, whatever, of all the assets under management, and that has benefit because the more your assets grow, the better they do, and so they want you to grow your assets, and you're aligned. But Ryan does an hourly rate, and we didn't get a chance to ask him why. Like, why do you do an hourly rate? But the other side of it too is he's teaching his clients how to fish. He's teaching them how to do through that process, I believe, as opposed to just doing it for them on the percentage basis. And if he does a good job in coaching them and training them and they do well in their investment portfolio, they will continue to work with him and get his advisement. So I really like that model where he's, hey, look, if I provide value, you'll pay for me. If I don't provide value, you won't, as opposed to I'm just going to make money on your assets, whether I'm doing a good job or not. So I really appreciate that and would have loved to have asked him a little deeper about why his why was for that. But if I had to suspect, that may be part of the reason.
John, I don't propose I know Ryan's reason. However, I will say there are investing vehicles that investment advisors don't get paid anything if they were to recommend. One of those is just going to treasurydirect.gov. And there was a time not long ago, maybe a year or two ago, that I-bonds, you could get a fixed rate on an I-bond fixed for 6 months of 7.5%. 7.5% as recently as like a year and a half, 2 years ago. No investment advisor is going to recommend that because they don't make money to recommend that.
Good point.
If they're fee-based, they can go outside of what is traditional with insurances and mutual funds and going and having a Series 7 so they could trade stock. They can go outside of that and look at some non-traditional things and be opportunistic even when it comes to if the bond market has an opportunity and they get paid to be your partner the entire way.
Rich, that's a great point. I mean, when you trade or have your wealth portfolio with JP Morgan or a very large institution, they're highly regulated. They can only talk to you about certain things. They can't talk to you about other things. So there are some different regulations and rules of the road to your point, but I consider you an advisor, and you never told me about the I-bond. So I'm a little disappointed.
I didn't make money.
About this now.
I didn't make money on it. If you wanted to pay me, I'd be fee-based for you.
No, I appreciate that. Hopefully next time you'll let me know about anything going on like that. I'll pay you for it.